Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Kargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. If anybody is new to the show, welcome. And you have a question, you can put that question on a live chat on YouTube. Will's watching it. He'll read it back to me. If you want to come on the show and ask your question live, we also provide a link to Zoom. Click on that link. That takes you over to Zoom. Once you're in Zoom, there's a button, raise your hand. Click on that button. It'll prompt you to turn on your video camera. You don't have to do that. Once we let you in, everybody will be able to hear you, and you could ask your question live and direct. While we're waiting for questions to come in, what we'll do is take a look at the pre-market report, see what's trading in pre-market hours. Then if we don't have any questions, what I'll do is go over some website tools and features that I've been getting questions over the emails. So I will cover those questions if we don't have any questions coming in. Sound good? Okay. Let's start out pre-market report. And these are stocks that are trading in a pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. I see here 42 stocks made our percentage gainers list, 18 on the decliners. From this perspective, we look like we're setting up for a more bullish bias at the open. I'm going to filter this list to stocks that are only in the S&P 500. We want to take out ETFs, closed-end funds, preferreds. Let's take those stocks out and focus only on S&P 500 companies to get a perspective of what's going on there. And to do that, I'm going to use the filters above. This one in ETF, when you select it, you get a drop down of a list of different ETFs. When you click on one of the ETFs, the list below will get filtered by stocks that are holdings in that ETF. And let's try SPY here. That's the S&P 500 ETF. Click on that, and you see the list below got filtered by stocks that are in the SPY ETF, which are the S&P 500 constituents. And here we got 3 stocks that made our percentage gainers list, 2 on the decliners. Kind of even there. Not much going on as far as that goes. I think Tesla was in the news a little bit, right, with Elon saying that he may actually back away from heading Twitter. He put out a vote there.
And yeah, well, he put it on Twitter, and he said he would abide by the results. And I think it was like 57, 43 that he people didn't want him to maintain his role as for running Twitter.
Right. And now, based on that, what the thought process is, he'll come back and focus on Tesla, and that's why we've seen Tesla up a little bit.
That's the thought process, of maybe he would move out of his Twitter headquarters and get back to Austin, Texas, and running Tesla day to day.
Right. So it'll be interesting to see what he does after that vote. Meta, that was in the news too. I think that they're getting sued in Europe with anti competitive or monopoly type of lawsuits, and so they're going to have to deal with that. I think that's some negative news out there, and of course, I think these social media companies are in focus as far as regulations go. And
I don't know if that's scarier, or the fact that governments are coming in and, you know,
regulating the,
finding ways to maybe claw back money, right? I mean, the way I guess the law has been set up is they can, for whatever they're being either sued for, the government's investigating, they can claw back or penalize 10% of revenue or something. It's a very large number.
really,
You know, and this could happen to anyone who does any business online, right? You know, it's like how you maintain your I mean, I mean, you know, if Meta can't do it, no one can do it, right? And so that means they can go after anyone's revenue who has an online business. Just Meta is the one they're choosing because it's a big, you know, money potential revenue source for the governments. You know, they're trying to do things with the oil companies there too. Windfall profit taxes, you know, they can make changes that can make your business very hard.
Right. Yeah, they're definitely in focus. The social media companies are definitely in focus, especially with, you know, what they're doing with your data, with privacy, you know, with anti-competitive practices, because they have such a large audience and they control so much. I think also this Moderna, they came out with some good results with trying to either cure cancer or stop it, but I don't know what exactly it is. I was trying to read a little bit about it, but something where it goes after the cancer cells and eats the cancer cells. So that was pretty exciting news last week, right?
Yeah, that's a win.
Yes, that's a big win. I don't think, you know, it's happening next week, but definitely some good results worth reading about for sure. If we don't have any questions yet coming in, what I'll do is navigate to SPY. And perfect. Let's take a look at the implied volatility chart. I do get questions on the implied volatility chart in SPY over here. So we went to SPY under volatility, over here, implied volatility chart. And the default chart is the 30-day IV. And we have, you know, the daily closing IV level. And on top of that, we have the option volume. Okay, so these are the two defaults, 30-day IV and the option volume that day. I'm going to come up here before we talk about this chart. And here we have a table also comparing the different implied volatility levels versus realized volatility. And here, the IV30, this is where we're currently at, 22, which you could see here. That's in the moderate level, which is saying that, you know, 45% of the observations were below the current level. The 52-week average for the IV is 22.4. So you can see we're a little bit below that. The high, 31.4. The low, 12.2.
Hey, Dave.
Yeah.
Rob is asking, is there a relationship between the IV chart Dimitri is showing and the implied moves chart under it?
Well, I don't see an implied moves chart underneath. This here is the stock price of SPY. So this is showing the IV level, and this is showing where the stock was at that time.
So underneath it's showing
the actual
stock and the volume.
Price.
All right.
Yeah. So this will be the stock price of SPY. This is the implied volatility of SPY. Okay.
All right. Well, there you go.
Parts. Yep. So you could see them, you know, in relation to each other. And of course, this implied volatility, what it's doing is looking at the option prices, and the option prices, if you put them into the Black-Scholes model, the binomial, and then you could get the implied volatility, which is the expectation of what the volatility will be going forward based on those option prices. Okay, so if you work backwards, putting in option prices, then that going through the model, you could derive the implied volatility of that option, right? And this is looking at the 30-day at the money IB. So constant maturity, 30-day IB. And we could compare that to historical vol, because implied volatility is a forecast of future volatility. Okay, so at that time, this was the forecast of the future volatility of the stock. And one way we could compare it is where the volatility of the stock was historically, the actual volatility. And here, right here, we look at back last 20 days and last 252. Question is, well, why do we look back 20 days, not 30? The IV 30 are 30 calendar days. Okay, so when we look at the IV 30, we look at the two expirations that straddle 30 calendar days. There's a formula to figure out, the weighted average, same as the VIX, of what a 30-day constant maturity option would be. And that includes weekends and holidays and so forth.
Hey, D.
Eric, yep.
Rob clarified his question. He's asking if the chart you're looking at has any relationship where if you look to the left-hand side under SPY menu, down volatility all the way at the bottom, the implied moves.
Right.
That if it has any relationship to that.
No, not this 30-day IV. I'll get back to the implied moves, but this is actually referencing a different. These daily moves are referencing options that are near term. So it's not going back out 30 days. It's looking at the very near term options to get the implied daily move from them. So it's looking at closer options that expire, more than 1 day away, but the ones that are near term. The other one, this implied volatility, is always looking at an interpolated 30-day. Okay, so 30 days out, not 7 days, not 5 days, not 4 days. It's always going 30 days out. So not a direct relationship between these implied moves.
Perfect.
And that's why 30 days, really, that was a benchmark created by the industry. And before we had even weeklies, we always had a 30-day, right, a new monthly expiration. Going back, the weeklies, dailies, all those have been, more recent listings, and they don't exist in all stocks. So we don't have weeklies in every stock that has options. But that's really the benchmark for a long time that the industry referenced. The VIX itself is a 30-day constant maturity. So when people trade the VIX, they're really trading a 30-day constant maturity implied vol. Okay. When we compare to the historical vol, here we use 20 days. The reason we chose 20 days is that a 30-day constant maturity is 30 calendar days. And of course, in calendar days, you have weekends, the stock doesn't trade, right? Holidays, the stock doesn't trade. And if you put those into consideration, there's about 20 trading days in a month, right? About 20 out of 30, about 20 trading days in a month, just to give it an even number. So we look at the historical 20-day to compare to the IV 30. Okay, if you go 30 days of trading days, you're going to go over, a lot over, right? So approximately that's where it is, 20 days. We also look at the historical 252-day volatility to smooth it out. what is the average volatility over a year in SPY. And now we could compare the current ones. Right, so currently IV 3022, in the last 20 days, SPY moved close to 22. So the market is forecasting that the volatility going forward next month will look similar to the volatility in the previous month. Okay, that's how we're looking at that. And if we look at the volatility in SPY over a longer period of time, the last 252 trading days, which is about a year, right? That's in trading days. It's a little bit below there, right? So the market is forecasting 22 volatility versus in the last year, the average volatility was 24.3, average realized volatility. Okay. So this is comparing implied versus actual realized. Well, here we could take a look at the 52-week averages. So in the last year, the average implied volatility was 22.4, very close to where it is now. Average 20-day volatility was 23, and the average 52-week over the course is 18.7. So this is the current, this is the averages. Okay. Then we could look at the highs. Implied volatility high 31.4, 20-day high 31.7, high of the 252-day moving average 24.3, the low 12.2 implied volatility, the lowest realized volatility 14.2, and the low 252-day moving average 12.7. Okay, so in that table, what we're doing is taking out points from these charts, right? When we could add, and we're just showing the current high-low average. All right. So let's come down here and take a look at this implied vol. This is the 30-day IV daily closing. Right. I'm going to take out the option volume just so it's a little bit clearer. And what we could do is overlay it with the 20-day moving average to see where it's trending. Because right here, sometimes it's hard to see, is it trending back up or down? And one way to try to spot a trend is to overlay another line that's smoothed out over a longer period, longer days. And we're going to take the 20-day moving average to see where we are today versus the 20-day moving average of the implied volatility. All right. And I'm going to click on this. And there we go. So this red line is the 20-day moving average IV, and the green line is the daily IV. And you could see here that since over here, the implied volatility has been trending lower, right? We've been below the 20-day IV, pulling it down. And with this recent sell-off, kind of popped back up over the 20-day average, indicating, that over here, at least it stopped trending lower and did cross that 20-day moving average, maybe on its way back up. But this is kind of overlaying two lines just to see which way, it's trending. We could also compare it to the realized volatility. And let me do the longer term. So this here is the realized 252-day moving average volatility. That's the realized volatility of the stock. Okay. And here we see that all year it's been trending up. It's a little bit easier to see on this more smoothed out line that all year it's been trending higher. And we discussed one of the reasons is that I believe is as you raise interest rates, as interest rates keep going up, up, and up, volatility will also move higher, higher, and higher because it's creating less liquidity, right? It's pulling out liquidity out of the stock market. It's also making it much harder to forecast the future earnings and cash flows of companies, creating more uncertainties. So volatility will start to move higher as interest rates move higher as well. And that we could see here on the realized volatility as interest rates have been moving up all year, so has the realized vol. All right, everybody see that? And we could overlay it with the 20-day moving average realized vol. So I could take this out, and this is showing what the implied volatility was relative to the previous 20-day realized volatility. Okay, that's what this chart is showing. How much they diverged. The most recent volatility with the forecasted volatility going forward. And you could see here where, they places where they diverged by a lot. Okay. Another thing we could do here is compare implied volatility of SPY versus another asset. So let's do maybe IWM. Okay, so this is the Russell. So I'm going to take this off. And we could look at how the implied volatility or daily closing implied volatility compared to two different assets and how much they diverged. And we could see here that the implied volatility of IWM in the red line is consistently above the implied volatility of SPY, the green line. And really because those stocks are more volatile, right? The Russell 2000 are more volatile than the S&P 500. That makes sense for that volatility to be higher. And we could see that there were times that the gap between the two closed in, got a little bit closer, like over here. And then there are times that they widen out. And this could be a strategy where people look at cross assets and trade one versus another. And you probably heard of pairs trading. Pairs trading is buying one and shorting another asset in anticipation that the gap between the two will revert to some mean. All right, maybe one stock's overvalued, one's undervalued. That would be a pairs trade where you're buying and shorting at the same time. Well, that can happen also with volatility, right? You could trade one asset versus another by buying implied volatility, let's say in SPY, selling it in IWM, thinking, well, those two have diverged and that there will be some kind of mean reversion in implied volatilities. And when you're doing this, you're also somewhat hedged because if overall volatility goes up, well, you will lose on one and make on the other. If overall volatility goes down, well, you're going to, again, lose on one and should make on the other. So you're somewhat hedged against that overall volatility in the market if it moves up or down. And really, you're looking at the differences between the implied volatility in one asset versus the implied volatility in another. Okay, does that hopefully make sense to people? That's what this chart is showing. So if you think, that implied volatility, between these two assets has diverged in one, and it could go right or it could go the other way. It could be very close together, and you think it's going to revert back to the mean. That's a different type of strategy. But here we could at least visually see how the implied volatilities, how they diverge historically from each other, and where did they widen out and close up. If there are no questions, Will, we are heading closer to 9:30. I don't think I have enough time to jump to another report, so I'll leave it there.
A reminder, I think the next 2 Mondays are exchange holidays.
Yeah, we had,
So,
right, we have a lot of holidays now coming up.
yeah, so always be aware of, the options you're trading, the premium, everything, and just be aware of that. Yep. Great job, buddy.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, everyone. Have a great day, D. Bye.